Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me for this session, we have Krishna Mohanraj, Portfolio Manager at Diamond Hill Capital Management, David Souccar, International Portfolio Manager at Vontobel, and Crit Thomas, Global Market Strategist at Touchstone Investments. We're here to discuss opportunities within the international space. Gentlemen, it's great to have all of you with us. Welcome to Trade Talk. And Krishna, we'll kick it off with you. What's attractive about international markets right now? US, we tend to think very US.
Jill, thank you for having me again. It's a pleasure. Now, let me start with this. We really don't need to pick sides, US or international. We think we only have to pick stocks, right? Because what we're trying to do, we're trying to create and grow wealth. And wealth creation is happening everywhere, right? You see enormous amounts of wealth being created all around the world. Just take, for instance, the obesity drugs, the GLP-1 phenomenon that you're seeing. Just in the last 2 years, this little country of Denmark with Novo Nordisk has had such a huge impact on healthcare, pretty much changing the landscape of global healthcare. There's just so many stories like that in international. If you start listing them, there's a TSMC in Taiwan or a HDFC Bank in India or a Samsung in Korea. There's just so many examples of enormous wealth creation outside the US. So given that, our basic premise is why would we not want to take advantage of international markets? And the reason really we're so excited about international is simply that there are so many great businesses outside. And you mentioned the US. I feel that there is a complete lack of imagination in the way people invest today in the US. Everyone piling up on a handful of US mega caps, which, by the way, account for most of the interest and most of the headlines. That herd behavior is really where the opportunity is for us, and that's what's exciting for us.
Mm-hmm. And David, you mentioned the same thing too about home bias and necessarily anchoring to your benchmark. It is pretty short-sighted if that's how you're approaching your portfolio.
Yeah, I couldn't agree more, Krishna. I think U.S. investors tend to have a home bias, and that's understandable because that's what they feel comfortable with. But I always think about this way. Imagine if you're going to a supermarket. When people go to supermarket, they don't say, I want to buy today just US products or I want to buy international products. If you happen to like Budweiser, that's great. If you want to drink Heineken, that's great too. What matters at the end of the day is that you have the basket of products that you like the most. And I think it's the same thing for international, for investment. You want to have a portfolio with the best companies in the world. Some of them are in the US, some of them happen to be outside the United States. Krishna mentioned a couple of them. I will mention other names like Hermes, or in Japan, Keynes, Schneider Electric in France, et cetera, et cetera. So there are many great opportunities. And I think investors who are just focused on the United States are missing some of these great stocks.
Right. And Crit, what's your approach when you think about diversifying diversifying your exposure internationally?
Sure. So, well, thanks for having me. And I just want to sort of juxtapose where I stand versus Krishna and David, because they have the luxury of being able to pick individual stocks, whereas I basically have to deal with the index. And so as a big macro strategist, I'm thinking about asset allocation. We definitely believe in having international exposure, although right now tactically we're underweight the MSCI EAFE, which is developed markets ex-US. But we see an opportunity that could be developing here, I think, in the second half of this year. There's been two big headwinds for U.S. investors internationally. First is currency, and second is relative earnings. And I think both of those headwinds have the opportunity of becoming tailwinds. We saw the dollar peak versus the euro and the UK pound last year. We're still near peaks versus the yen, but it seems like the BOJ is willing to start to support their currency now, so that could be becoming a tailwind. The bigger factor is earnings, and we are seeing more and more signs of our economy starting to slow down, just as say Europe and the UK are starting to bottom, and we're anticipating that their central banks start to ease, which we think we'll have more success in those economies than we're going to see here in the U.S.
And
Jill,
that's the point that you
if I
make.
could add
Yes, of course.
one point that Krit made about the currency, I think that's very important. You know, U.S. investors are basically assuming that the U.S. is going to be the stronger currency forever. That's not been always the case. I was just in Japan back in February, and the things are super cheap there. If you try to buy a Big Mac in Tokyo right now, it costs $3. In New York, it's $6. So the odds are much more that foreign currencies are going to appreciate versus the dollar, especially given the expanding deficit that we're seeing here in the United States.
Yeah, well, let's talk about that some more. And Krishna, what are your thoughts around the impact of U.S. policy as it applies to other international markets? How impactful is the macro environment here to other investments?
Jill, most investors, when they think about international, they think macro, right? They think about geopolitics, war. You mentioned U.S. politics. They think about international as simply uncertainty and risk. They're afraid of the bad headlines, right? It is very hard to predict exactly how things are going to go. You just have too many variables to consider. But think about the last 10 years or so, right? We've seen Brexit, we've seen trade wars, we've seen COVID, we've seen vaccine and recovery. We've seen multiple markets going back into shutdown, back to reopening, inflation, central banks tightening, 2 wars ongoing, an entire country, Russia, disappearing from capital markets. Every point in time, right? There were so many big, difficult macro questions to be asked. But what's important is that during all this time, if you're a stock picker in international markets, you made money, right? So the lesson really for us is not to worry so much about macro. As long as you have a long enough time horizon, you want to pick stocks and invest in companies, and that's how we think about it.
So essentially investing in companies, not countries, is how you're approaching it. Yeah, and I think that's a good point to make. I mean, especially, the calculus, even in terms of U.S. domestic politics, has changed as well over the past 10 years, where there is a certain amount of uncertainty within our landscape as well.
Yeah, across the board.
So whether you're investing in the U.S. or any other part of the company.
In fact, just think about 2024, right? 2024 is not a big election year. It is the election year. It's like more than half the democratic world, I think, is going to the polls. We just saw India and Mexico. Results of the polls come out just today and tomorrow for India. So there is just so much uncertainty that if you're waiting to invest, once things clear out, you would never really invest in any market, including the US market.
Yeah, and Krit, I'm interested to get your perspective on this. Do you think we'll be in some of a holding pattern until we clarity in terms of what the election looks like? I mean, it doesn't necessarily mean it's going to be over on November election day. I mean, there are different number of scenarios that can play out here.
Definitely, there are a lot of uncertainties. I think for us, the path of monetary policy is going to be very important. We anticipate that both the Bank of England and the ECB cut here in June, but that's pretty much expected. The question is how much can they do going forward, and there's really little visibility on that. The thesis that we've been operating under is that our economy has remained resilient because it is much less interest rate sensitive. So we've had one of the most aggressive, monetary tightenings that we've seen in decades, and yet, the economy is still doing well. Part of that is the amount of fiscal spending that we did over the course of the COVID crisis. And then you lop onto that businesses and consumers that were able to refi and term out debt at really low interest rates. But if I look over at Europe and the UK, they did not do the amount of fiscal stimulus that we did. And then they can't term out and refi in the fashion that we had. There is no 30-year mortgage if you go over to Europe. And if you look at most businesses, they borrow through the banking system, which is where basically monetary policy operates through. So the economies over there have been much weaker with less tightness in terms of monetary policy because they're more interest rate sensitive. But if you turn that around, if they start lowering rates, that means that we should get more bang for the buck over there than we are likely to see over here. So a lot of people are really excited about when the Fed cuts rates, but honestly, how much are we going to get in terms of traction from that relative to what we could see overseas?
Right. Well, of course, you want to be careful what you wish for too. The more rate cuts you get, that means that signals that there's something challenging the economy as well. I mean, the U.S. markets were priced in 6 to 7 rate cuts in the beginning of the year, and you're sitting at nearly all-time highs now, focused on corporate earnings and how well companies have operated in this environment. So, David, when you think about it in that context, when you're looking at stock selection specific companies, I know you're looking at companies that have that pricing power.
Yeah. So we focus on companies that have the pricing power, they have high margins, high returns, strong balance sheet. So if we have a soft landing or hard landing, I think those are companies, because of their nature, they have the levers to adjust their business models to whatever macro situation is going to come. I think the debate now is if we're going to have a hard landing or soft landing, is what's going to happen with multiples. There is a case that if we have a soft landing, maybe value stocks are going to do better than growth stocks or vice versa. So that's the big unknown, but we do not have a great answer about that. So what we do is stay in great companies and navigate the different scenarios through them.
Yeah. And Krishna, I'm taking a look at your picks here too. I mean, you're looking to capitalize on what's happening within the chip space. And then, of course, companies that are providing this power for the demand that's coming online with all these technologies that require it.
Yeah, I mean, let's just take the example of Samsung, right, which is a big position for us. If you think about the best brands in the world, right, again, going back to the original point, the US doesn't have a monopoly on them. It turns out that Samsung is actually the 5th most valuable brand in the world, right? It's everywhere. You've got the phones, you've got the TVs, you've got the refrigerators and washing machines. We see Samsung all around us. But the crown jewel for Samsung, where the bulk of the profits come from, are not the consumer devices, but the underlying memory chips that go into these devices, right? And Samsung has simply a dominant position in that market, right? Now, AI, of course, is all the rage. It's caught us by surprise. The speed at which you're seeing NVIDIA's AI chips ticking off, right? It's breathtaking. But there's a silent need behind all this for the special memory chip, the high bandwidth memory chip that Samsung and only a few other players make, right? Over the next few years, we think they're going to see a huge demand for memory chips. And you put that together with a really diversified business model and amazing brand, and really a national champion in Korea, you just have an easy way to play so-called the AI theme in a very, very valuation attractive way.
Yeah, and we're seeing that in the US as well. But another area where we're starting to see some sort of a sector rotation is energy, or the companies that are providing this power or the electronification for AI to be able to execute, right? So Glencore, as an example, is one that you think is attractive as well for.
Yeah, Glencore is right. It's a global mining company. It's a British listed company, but really what you're getting with Glencore is global assets in copper, in metallurgical coal, and really a world-class commodity trading business, right? It's managed extremely sharply in terms of return on capital, cash flows, very aligned with shareholders. It's something which we really like. And as you mentioned, there's an increasing need for copper. And really with copper, the only question you have to ask is, where is it going to come from, right? We find the way Glencore is managing the cash flows out of metallurgical coal and investing into copper is a very, very intelligent long-term way to think about business. And we find that super attractive. And ultimately, as a stock picker, you're finding an opportunity like that in international that you really don't find an equivalent in the US.
Yeah. Jill, let me add to Krishna so the viewers can understand the power of investing international. If you want to extract copper, you need equipment. And there's a great company in Sweden called Epiroc. If you want to power the data centers, you need electrical equipment. And there's a great company in France called Schneider Electric. And if you actually, and NVIDIA, once they want to make the chips, they have to work with TSMC, which is the global leader in making, very sophisticated chips with small nodes.
Yeah. Well, and to wrap up here, it's interesting because a lot of the themes that we see emerging with international stock picks really have been the key themes that have been, a key part of the narrative in U.S. markets as well. The technology story, whether it's, exclusive to the Mag 7, although I think we're starting to see that broaden out a bit, or, the energy play. I mean, we've seen that rotation, utilities as an example, or moving into energy as well. We're seeing that in the U.S.
Yeah.
Yeah, that's correct. But it still hasn't fed completely over. And one of the things that David brought up is growth versus value. The MSCI EAFE index has a value tilt, and what we've yet to see here in the U.S. market is a transition over to value, and I think that's another one of the things that we're waiting for to get us a little bit more excited about the international EAFE.
Right.
And if I can add to that, the advantage we have of not being focused on the benchmark so much is that we don't have to play value or growth in the traditional quantitative statistical way that it's defined. We can go after intrinsic value wherever we find it, right? So it might be what gets classified as a growth stock is something that we find attractive, or what might be get classified as a deep value stock might be still attractive on an intrinsic value basis. So that is a big advantage of being a stock picker in these markets, and I'm glad you highlighted that earlier as well.
Mm-hmm.
Right. Gentlemen, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks so much.
Thank you, Jill.
Thank you.